Buckle up as we delve into the possibility of a housing market collapse with soaring prices, higher interest rates, economic concerns, all sorts of things going on right now that could contribute to a housing market correction. So stick around to the end of the video for a lot of interesting content as I discuss all of these things and more. Good morning. Today is Thursday, October 12th. And for those of you who don't know me, my name is Adam Kahn, and I'm the Rational Investor. I hope you're all enjoying your day. Before I get into the video about the housing market and what I see in the future, which is good a guess as anybody's, do me a favor, hit that subscribe button, smash that like button. It really helps out YouTube's algorithm. And if you like the content that I'm providing, it helps to get the information out there. To be honest, those of you who've lasted this long, from the analysis I've read, you've beaten about 80% of the people who actually click on most videos, so thank you for sticking around. I'll also put a little link in the description for opening a SoFi account. I have an account with them myself. If you click on the link, it'll allow you to get an extra $25 if you make a $10 deposit or more. And it also does similar for my son, who's 12 years old. It gets him really excited when that happens. So I appreciate that as well. So let's talk about the housing market a little bit. We had some economic data come out today that spooked the market a little bit, and you've seen bonds reverse from the past couple days. The rates have been improving a little bit. Today they're a little bit worse. And there's a lot of nervousness about the housing market. There's also a lot of people on YouTube that are very fear-mongering and gloom and doomers. Now, for full disclosure, I am a loan officer as well. And there's a lot of comments about people making self-serving comments just because they want people to buy when we know the housing market's going to collapse. I am going to tell you something. We have no idea what the market's going to do, and neither do they. I don't know if it's going to continue higher or it's going to continue lower, but talking somebody out of buying a home, if it continues to get more expensive, whether that's in price or rate, is just as damaging as telling somebody to buy a home if the market corrects. And I think everybody needs to make their own decisions for these things. And my personal opinion is I don't really see a huge correction coming. Things are different from 2008. There are definitely some similarities, and there's some reason to be fearful. The Fed has made it very clear they're going to keep rates higher for longer, and things like consumer price index and unemployment rates and things like that continue to come in hotter than expected, which is also a contributing factor to confirm that the Fed's going to keep it higher for longer. The theory is that'll cause a correction, but there's also a lack of inventory that's really real as well. And those people who have interest rates in the 2s and 3s and 4s and even the 5s, now that rates are pushing the 7s and 8s, they're less likely to list their property. So where we see new inventory coming from, I'm not really sure. One of the people out there, he keeps talking about the new subprime being grade A paper with the rates in the 2s and 3s. I think there's a lack of understanding about that. It isn't subprime. These are good mortgages. Now, the bonds are selling for 50 cents on the dollar, so the banks that own those notes are taking paper losses on them, or if they sell them, they take actual losses. If the banks are properly pricing them, that should be updated every day, and it shouldn't be some big shock. What happened with some of the banks that closed is they were trying not to market on their paper, so they weren't taking the paper losses and updating their statements accurately. So when that kind of came to fruition and there was a bank run and people pulled their money out, they were short funds to actually the real position they had. At the same time, if you're properly marking these to your books, it just is what it is, and it's part of the buying and selling of bond markets. For those of you who were in the markets back in 2005, 6, 7, and 8, and remember as well as I do, things were different with the loans that were offered as well. They had this option ARM program, and you could even get a first and a second loan where you were putting no money out of pocket. You'd put down the equivalent to 20% down, but then you would take another loan for the additional 20%. And these mortgages were based on stated income, and stated assets. So as long as you had decent credit, you could go in and say, I make $500,000 a year and I have plenty of money for down payment, and they didn't collect any documentation. Well, these loans were on adjustable rates and they would mature over time. And the payment was usually 1/4 of what they would mature to when they seasoned. These option arm programs would have very low initial payments, and then after 5 years, they would mature into fully amortized loans. The goal of those loans, or what they're really intended for, is investment purposes. If you're buying a house and fixing it up and you're going to flip it, well, you want the payment as low as possible while you work on the property, and you're not super concerned about how much you'll owe on the house in the end, as long as there's enough profits in it to flip the house and sell it. They really weren't intended to be used the way they were getting used, and these loans got abused. They got used for people who were just getting in houses and whatever else. Even if you watch the movie the Big Short, they don't talk about it and call it by name, but that's the loans they're talking about when they talk about subprime mortgages. And it's not a bad product, it was just used poorly. So people are comparing those to the debt servicing programs that are being used today. And it's a poor comparison because the debt servicing programs are intended for investors. You need to show that the property is being used for a rental property. And if you're lying about that and using it for your primary residence, there are other programs available that make more sense, like a bank statement or an asset depletion one. So a debt servicing program typically requires either 20 or 25% down, as well as good credit, and they actually check to make sure these things are there, as opposed to just stated income and stated docs. They're typically not an adjustable rate loan either, and the investors know the risk they're taking, and that's why they require the down payments they require. They're willing to take those risks, and they also have a higher interest rate associated with them because of those risks. Those other programs back from 2005, 6, and 7 were a different program. Now, I'm not saying we don't have some risks in the market. What I am saying is telling people not to buy. I mean, I've been watching people who've been saying this for 2 or 3 years, and there's no repercussion for the fact that they've cost people tons of money if people are listening to them. As the market's gone up 20, 30, 40%, and rates have as well, and they've missed great opportunity. Nobody seems to have an issue with people saying don't buy, don't buy, don't buy as the market's gone higher. Is that self-serving because it grows their YouTube's accounts or whatever it is, including some of them? It actually helps build their base because some of these guys are realtors as well. And it's pretty interesting how they're telling you not to buy, and then they're saying, but at the same time, if you're looking to buy in this area, feel free to reach out to me because I'll be happy to help you. It's just an interesting dynamic that I've noticed in some of those videos. Now, I can tell there's a few of them who really care about the people and they're really concerned. But that's my point of nobody knows where the markets are really going, and it could continue higher, and we could see a correction. I'm not sure where I stand in that, and I'll have that conversation with my clients. I just want to make sure people are in the position to afford what they're buying and comfortable with the payments. Because if they are, I don't want people so scared of being in the market that they don't invest, whether that's with stocks or real estate or whatever it is that they see as value. The other thing with real estate, if you're buying your primary residence, there's more to it than just math. There's security of a place to live. There's knowing that you won't get kicked out by a landlord. There's the freedom to paint the walls pink if you want to paint the walls pink, or change the floors or the microwave or the oven or whatever it is you want to do because it's your home. There's a pride in ownership as well. It just doesn't get accounted for, especially in these videos comparing rent to owning and saying that rent is just better. There's differences amongst them as well. It's not just straight math. The really interesting thing that I see in the market is I'm beginning to see the yield curve beginning to flatten out. And I could see a scenario where the Fed does not continue to raise, and you see the 10-year as well as the 30-year continue to go down in price and higher in rate. Bill Ackman even put on a rather large trade recently, shorting the bonds, which means he thinks yields are going to continue to get higher, and he did that on the long end. I find it a really interesting scenario, and it's funny because I made a comment in one person's videos, and I see him talking about it now too, because I think I'm really the only one out there who has this viewpoint. I think if the long end of the curve uninverts naturally and you see the bonds make a normal yield curve, as opposed to seeing a recession coming and the Fed needing to cut rates, which uninverts the yield curve, I think that's actually pretty healthy and pretty good for the markets. It's showing that while people are stretched, things are slowing appropriately. Maybe inflation is tame, but where it is, and people should get paid appropriately for the duration of the bonds they're putting on. And I'd really kind of hope for that. I hope the economy keeps chugging along and people are upset that things cost more than they did a few years ago, but that they've learned to adjust. So the economy slows the way the Fed was hoping, but doesn't slow to a terrible recession or just depression that's much bigger than people expect. Maybe we just slow a bit and things keep chugging along. Anyway, again, don't forget to give a thumbs up, like, and subscribe. Chime in, tell me what you guys think. Do you see a big recession coming? Do you see a depression? Do you think there's going to be a lot of unemployment? Why do you think the housing market's going to collapse? Happy to discuss it, and I just don't see that we have some big collapse coming. Have a great day.